All right, I do want to bring in our next guest for more on the markets. David Waddell, he's the CEO and Chief Investment Strategist at Waddell and Associates. David, it's good to see you this morning. So we are awaiting these ADP figures at 8:15 a.m. Eastern time. What are you anticipating?
Well, so far, the economic data that's come out has been better than expected. I'm kind of pulling for this to be worse than expected because that's going to cause Congress to act. So you heard Mnuchin this morning. That's what's most important. So the economic data has been strong across the board. If you look at the ISM numbers we got yesterday, it actually indicates probably that there's more employment coming. So it'll probably surprise to the upside, but I'm hoping for the under because I need Congress to give us more stimulus.
And when it comes to stimulus, I mean, many people were expecting and pricing it in that we would get that at the end of July or early August before Congress went on recess. We're still without it, yet the market continues to surge higher. So how much does the market really need a new stimulus deal?
I think stimulus and a vaccine just adds more fuel to this rally. But what's really beneath the rally is the complete and total regime change we've gotten at the Federal Reserve, where they've gotten out of the inflation fighting business into the deflation fighting business. And so if you look at interest rates all around the planet now, they're pegged at zero and they're going to be there for a while. And in that environment, the question is, what are you willing to pay for equities, right? So right now, people are paying 22 times forward earnings. That would give you sort of an effective earnings yield of 4%. Which would you rather have, 0 or 4? And just to give you a sense of how powerful that could be, there's $100 trillion in the global bond market. There's $75 trillion in the stock market. So that $100 trillion is earning 0, and the $75 trillion is earning basically an earnings yield of 4%. So there's a huge repricing between asset classes happening on the planet right now. That's the most important thing. Ultimately, the multiples rise, the earnings rise, and the markets rise. And so we're in this holy trinity of, security prices right now.
David, it's been interesting to see a story in Bloomberg News this morning that the volatility market is pricing in the biggest risk ever for the market, and that is that we might not get the election results immediately come election day, that it could take weeks till the end of November to actually get a real result, partly because of mail-in voting. What risk do you see that to the market?
I'm getting a lot of calls from our clients, very anxious about the election. Now, there's not a whole bunch of data on this stuff because these things really only happen every 4 years or so. But if the incumbent party wins, markets tend to grind higher up to the election day, and then November and December tend to be pretty good. If the incumbent party loses, the markets kind of grind lower from here into election day, maybe 5% or so, but then also grind higher in November and December. So I think Wall Street is correct to price in some anxiety up until election day, and there is historical precedent for that. But once you get past election day, markets tend to rise. And again, I think the underlying force of having a zero interest rate regime all over the planet is more powerful than whether Donald Trump or Joe Biden get elected. I guess, is there a third choice, or is it just those two at this point?
There is a Bitcoin billionaire, David, who has been endorsed by Kanye West. So I do think that he is in the mix.
Okay, good. All right, well, add that to the volatility mix.
Yeah, he is in the mix as well. But let's talk about what makes this election different, right? Regardless of your party, I mean, I think the real concern is that our election integrity is on the line. All the uncertainty that has littered 2020. I mean, it could really come to a head early November if it does take us 3 weeks, 4 weeks to actually get the results. And then if we have people from different sides, different political camps claiming that there's no merit to those results, I mean, it could be complete chaos. So that alone, what risk does that pose? I understand the data can show how different parties will change, of course, the reaction to that, but are markets pricing in sort of a Brexit event where we could just collapse the next day simply because there is no result?
It's important for people to understand what I'm getting ready to say. We invest in companies, not governments, right? And so the government regimes change over time. Some are a little bit more supportive to the free market system or the markets or lower tax regimes, et cetera. But there is sort of this divine path that stocks follow. Earnings grow on average about 6%. They pay out a couple of percent in dividends, and then you get multiple growth over time. And companies are operating in a global environment, right? So they can shift tax regimes if they've done in the past. They can make adjustments, and so we get caught up in the short term with what's happening politically, but in the longer term, really both parties want to get reelected. The way you get reelected is through higher GDP growth and prosperity. So there's fear that if Biden gets elected, that taxes are going to go up. They probably will, but spending will probably go up more than taxes, and that's additive to the economy. If Trump gets reelected, then maybe taxes go down. But spending still stays relatively high, which is additive for the economy. So both of them run a stimulus agenda. They just structure it in different ways. So there may be some intermediate term anxiety, kind of like we had with Al Gore. But I don't think that mortally wounds this market because, like I said, they're just larger forces at play.
So I do want to ask you about Macys earnings, big picture, David. Macys actually up about 6% pre-market after we saw same-store sales plummet, but digital sales continued to be a bit of a boon throughout the second quarter during the pandemic. Does Macys say anything about the retail sector? Does it make you feel any more comfortable about the retail sector that has been hit with dozens of bankruptcies so far this year?
Yes, but it's kind of like the duck on the water, right? At the macro level, the economy's gliding, and the reason it's gliding is it's had so much support. We had a $2 trillion problem because of COVID. We've had a $10 trillion stimulus between the Fed and Congress to offset that. Retail sales are actually at a higher level today than they were back in February. It took us 5 months to get there. It took us 6 years after the great financial crisis. And the reason is because of all the stimulus that was provided. Without the stimulus, household personal income in the economy would have been down 7.5%. Because of the stimulus, household income's actually up 11%. Okay, so yes, the jobless rate is 10%, but most Americans basically received a raise during this period because of the amount of stimulus. And that has translated into retail sales that have been higher than people expected. It's also translated into a savings rate. So right now in America, the average American is saving 19% of their paycheck. So there's still dry powder and more stimulus to come. So I'm obviously an optimist at this particular moment, and I'm not always, but there's a lot of dry powder. There's a lot of income in the system. There are a lot of indicators that the economy is coming back online faster than people expect, which means hiring starts picking up. So I think it's just bullish across the board.
All right, David Waddell, CEO and Chief Investment Strategist at Waddell & Associates. Thanks.